Good morning to everyone on the West Coast, and good afternoon to everyone on the East Coast. Thank you for joining us for our third quarterly webinar. This is Marty DeZor, DeZor Compliance Consulting. I serve as the Chief Compliance Officer for IMST and IMST2. As a reminder, we are holding quarterly webinars as a joint effort between the service providers, FMAC, UMB Fund Services, Tate Weller, and DeZor Compliance Consulting. The purpose of these webinars is to provide you with pertinent information regarding your funds. Today's webinar focuses on tax issues, specifically your fund's annual distribution of net capital gains and income. Our goal is for you to better understand the distribution requirements and to learn about a few common tax adjustments that impact the distribution amount. In addition, we will discuss the process among UMB, FMAC, and Tate Weller to determine the distribution amounts for each fund in the trust. Our panelists today are Leonard DePietro from Tate Weller, Bruce Little from UMB. The distribution calculations are determined by our tax experts at Tate Weller and UMB. If you have any questions throughout the webinar, please type them in the questions box on the webinar control panel. As time permits, the panelists will answer your questions at the end of the presentation. If we do not get to your question during the webinar, we will contact you separately. To begin, Leonard will discuss the distribution requirements. Thank you. Leonard?
Hello, thank you everybody for attending. Good morning or good afternoon, depending on where you're at. Okay, I'm going to talk about the distribution requirements for mutual funds, and we should be on the first slide. Okay. Amy, did you go to the slides? I don't see anything yet. Hello?
Yes, they should be there, Len.
Okay, there they are. Just popped up. Okay. Okay. Little technical difficulty on my end. Okay, so we're going to talk about distributions. Mutual funds are all required to distribute all of their net investment income and net capital gains each year. And that's calculated basically on a fiscal year basis to determine what has to be distributed. Any income or gains that are left undistributed at the end of the year are known as a spillback or an 855 requirement. And the spillback must be distributed to shareholders by the end of the next fiscal year. One of the things of note in the board meeting, you must have notification in your board that you are going to distribute all your income. Most of the boards have a note in their minutes saying the funds will distribute any and all income and gains required to meet the requirements of Section 855 so that you're covered. Basically, we have to make these distributions to maintain our status as a mutual fund to consider our tax exempt or tax pass-through qualifications. Basically, if we were a corporation, we'd be paying taxes at the corporate level and then passing them down to shareholders who would again pay tax. So our status as a mutual fund gives us that benefit. Failure to make your required distributions can result in severe penalties. All income and gains will be taxed at the federal corporate level, and you have the loss of your RIC status. That could have many implications for a fund. Not only could have shareholder lawsuits and everything, God forbid if that happens. So with MFAC, Tate Weller, and UMB, everybody works to make sure that none of that stuff ever happens or goes wrong. Now, because we have to distribute all our income, we have a problem. Mutual funds are a different taxpayer than any other taxpayer. We are under two different tax regimes at the same time. We're under our fiscal year requirements and we're under our excise requirements. Your fiscal year is whatever your tax year happens to be, 7/1 to 6/30, 1/1 to 12/31. But your excise year is from 1/1 to 12/31 for income, and from 11/1 to 10/31 for capital gains. So when you're trying to do your distribution, that could cause some problems to coordinating between two different time periods. And we work those out when we're doing the calculations. Bruce and his team will prepare all those numbers to make sure that they're properly presented in the right character and presentation. Now, funds must distribute all their ordinary income on a January 1st to December 31st basis and capital gains from November 1st to October 31st. The reason the capital gains are offset a little bit is some of the tax adjustments have time to clear, like wash sales. We have to do the 30 days after, so we know what the proper wash sales are. If you did your capital gains to 12/31, you'd never be able to properly calculate those numbers. There is also an election for funds to elect 11/30 or 12/31 as their tax year end for capital gains. For an 11/30 fund, that's a wise decision. For a 12/31 fund, it is not. We do not recommend 12/31 funds to elect the 12/31 capital gains period. You would never get your calculations right, and you could end up being subject to excise tax because you under-distributed, or you could have over-distribution and a return of capital. So we highly recommend against that. Now, funds are required to distribute 98% of their net investment income and 98.2% of their capital gains to avoid excise tax. The excise tax is 4% on the undistributed amounts. So with that 2%, you're allowed to have a 2% cushion of what you are under-distributed by. Anything over that cushion, you pay tax on. So for example, if you have $100,000 in incoming gains for the year, you are required to distribute $98,000. If you distribute less than $98,000, you'll pay 4% on the dollars that are undistributed, and you will be required to distribute those next year. That's a mandatory requirement. Your distributions must be declared and paid by 12/31 of the excise year. A fund may make the 852B7 distribution, which is declared before 12/31 of the tax year end and paid in January of the next year. This is not a normal process. It's usually used by fund of funds. Fiscal versus excise distribution requirements. If you want to go to the next 2 slides, I'm sorry, I moved on and didn't tell you. Okay, fiscal versus excise requirements. Fiscal funds are required to distribute the greater of 855 or the excise requirement. And I was mentioning earlier about characterization. You're distributing on a calendar your fiscal year versus excise. So you could end up having a distribution of excise that is greater than your fiscal year end, or your fiscal year end which is greater than your excise. The calculations are done based on whichever one is the larger. If your 855 is larger, you must distribute that. If your excise is larger, you must distribute that. Now, the one difference is character of distributions is determined on a fiscal basis, not an excise basis, because what you calculate at excise time may not have the character of what you have during a fiscal year, and what you have for a fiscal year is what determines what goes on the 1099s at the end of the year. Even though your year end may end at 6/30, your 1099s are on any distribution made between 1/1 and 12/31. So we have to calculate those numbers based on that 1/1 to 12/31 the characteristics on a fiscal year basis, not on an excise basis, because they could change. Distributions are calculated using estimates for certain tax positions that you're unable to finalize at the time we're doing excise. For example, partnerships, REITs, and grantor trust. Partnerships is a perfect example. Partnerships, you don't get your K1 if you invest in any type of partnership or MLP until March, April, May, or June of the following year. But for tax purposes, you are considered to have received your K1 on 12/31, and that income must be included in the excise distribution. So we would make estimates to include those numbers in there to get as close as we can to get the numbers right and to avoid paying excise tax or having an over-distribution. Taxable distributions do not always match other income or gains shown on the trial balance. Because of these distributions, these tax adjustments, you can't look at your trial balance and say, oh, I have $10 million in long-term gains, that's what I have to distribute. They could be affected by a lot of different tax adjustments that could make your distributions go up or down. And another thing that affects what you have on your trial balance, capital loss carry-forwards and late-year loss deferrals will reduce or increase your distribution requirements. Will reduce your distribution requirements. Capital loss carryovers will reduce them because you may have $10 million worth of gains this year, but you may have $5 million worth of capital losses from a prior year that would be used up first, reducing your distribution to $5 million. So before you determine your distributions, you must take all those factors into consideration. Okay, and that is the end of my discussion on distributions. We can go to our next presentation. And common tax adjustments. If you go to the first slide, next slide, okay. I have this disclaimer in here. Basically, you're not going to become a tax expert after you get done with this seminar, but these are just some ideas on what's going on, so it kind of gives you an idea. If you have a new investment or something you're not sure of, you can either call MFAC, UMB, or us at Tate Weller to make sure that we walk you through and help you with these items, just so you don't get stuck with a tax adjustment that you did not know during the year that could have a major impact to your fund. So always just feel free to contact us at any time. We're always available. Next slide, please. Okay, now, as I've said, we're into the second part of this. This is the tax adjustments section, and this is the basically, this is what causes your income to be different from a book perspective versus a tax perspective. When you distribute on the funds on a fund, you distribute on a tax basis, not a book basis. When you do your numbers on the financials, everything's on a book basis. So there's two different regimes. Books count one thing and tax counts another. Tax, we only count the money that actually walks out into a shareholder's pocket. And what are tax adjustments? A tax item of income, expense, or gain, which is treated differently for tax purpose than it is for books. There's going to be additional slides showing some of these different tax adjustments, the more common ones, although there are many more than are presented here today. Tax adjustments may be permanent or temporary. A permanent adjustment is one that will be made and will not be reversed. For example, a REIT adjustment from income to capital gains on a REIT is a permanent adjustment, because what will happen is you're removing it from ordinary income and you're moving it to long-term capital gains. It's never going to reverse. But a wash sale is temporary. It's a loss that you're not allowed to take at the current period in time, but at some time in the future, you'll reverse that. So permanent adjustments basically never reverse out. They're there. The character, the adjustment stays, and temporary adjustments will reverse out at some future date. Another example of a temporary adjustment is a mark-to-market, which reverses the next year. So how do tax adjustments affect your mutual fund distribution? Tax adjustments can cause higher distributions of income or gains in the current period. This is sometimes known as phantom income. Basically, you're distributing something that you really didn't earn or have. A perfect example of this is the PFICs, which is discussed a little later. PFICs are, you're forced to mark the market, the difference that you have between what your cost is and what the market value is, and distribute that as income. Even though you didn't have any intention of distributing that, it's not income that you've earned, you have to distribute that as income. It's kind of a permanent adjustment, but it's also kind of a temporary adjustment, because it can reverse out depending on market conditions. And we'll get to that in the next slide. These tax adjustments may lower your distributable income and gains, reducing them. Information about tax adjustments may not be available until many months after the fiscal year end, when a fund cannot take action. For example, you may invest in REITs during the year, and your year end may be 6/30. But REIT adjustments aren't available until mid-January to mid-February, when all the REITs post their information on NA REIT or Wall Street Concepts, so you could do your reclasses. You wouldn't have that information at the time you're doing your financials or the time you're doing excise. So you would do it based on the best information available at the time and estimates that we would use. Distribution amounts, as I mentioned earlier, are calculated on a tax basis. Books are the starting point, but tax is the ending point of where you're going to end up with these distribution amounts. And book income and gains can be different from tax, as I mentioned a little bit earlier. You cannot look at the trial balance or gain loss to determine the distribution amount or character. It will be determined by the tax adjustments that we make, because there could be reclasses between buckets that could change the character of your distributions. Next slide, please. Okay, we're going to talk about a few different common tax adjustments that we have. These are wash sales, passive foreign investment companies, better known as PFICs, real estate investment trust, REITs, ETF and mutual fund investments. These have reclasses. Investments in partnerships, usually known as MLPs, futures, forwards, and options contracts, which would have 1256 or non-1256 treatment, and I'll explain that. And foreign currency contracts, which are Section 988 and would have FX treatment. These are probably the most common adjustments that you'll see in the mutual funds that you have. Almost all of our funds have some or all of these adjustments in their portfolios at any given time. There are hundreds of others that are out there that can be out there, but we've just picked on the ones that are the most common. Next slide, please. Okay, a wash sale is probably one of the oldest adjustments out there. Wash sales are tax adjustments under Section 1091, which require a taxpayer to defer the recognition of a loss on a security if the same security, which is substantially similar, is purchased within the 30-day window on either side of the sale. Wash sales have what's known as a 61-day window. So the day of the sale, if you purchase a lot of a similar security within 30 days on either side of the sale, you cannot take the loss in the current period. You have to tack that loss onto the new security that you just purchased and defer that loss, the recognition of that loss, until the time when you've sold that lot. So wash sales are a temporary adjustment which will reverse when the loss is attached is sold. Wash sales adjustments are calculated twice a year at fiscal and excise time. They can cause your distributions to be higher than the book gains. Basically what happens is they could cause them to be higher or lower. If you have a wash sale in the current year, you make a purchase which defers that wash sale. Those losses that you thought you had are going to be deferred. You could end up having gains to distribute because the losses that you have were deferred and you can't recognize them now. And then also, when you sell the securities and recognize those wash sales, the gains that you thought you had on those securities may go away because the wash sale loss that you're now taking may negate those gains. So it's something to keep in mind when you're trying to do planning for your distributions, the impact of wash sales. And wash sales are probably one of the biggest adjustments that mostly every fund has. I would say 9 out of 10 funds have wash sales in them. Wash sales are automated at UMB. They use a program called GainsKeeper to track the wash sales on a lot-by-lot basis. And they run a report to give us a position where we are on wash sales at any given time. So it's just one of the things that's out there, a tool that's useful to keep track of these. Next slide, please. Okay, the next issue is passive foreign investment companies, or PFICs. These are probably one of the more troublesome securities to invest in. PFICs are securities governed under the regulations of Section 1291 through 1298. A fund is required to file Form 8621 each year for each PFIC held. PFICs can take several forms, but the two most common that mutual funds use, we use the mark-to-market election, which I started to briefly speak about in the 2 slides ago, and we use the QEF election. Now, the mark-to-market election is an election that makes you take a mark-to-market or recognize the ordinary income that you have on those at the end of the year. So, for example, at the end of your fiscal year, you purchased Toyota Motor Company, and I'm just picking out a foreign company, it's not a PFIC, at $10 a share. And at the end of the year, it is worth $12 a share. The PFIC rules will make you mark-to-market that $2 and distribute that to your shareholders as ordinary income, what I mentioned earlier about phantom income. So you could have large amounts of income in your fund that you did not anticipate because of investments in foreign companies that are known as PFICs. The other election that you can make on a PFIC or a passive foreign investment company is the QEF election, the qualifying electing fund. This is an election you can make, and the security or company that you purchase has to make this election themselves. They have to provide a PFIC statement on their website that tells you the amount of income and gains and expenses that you need to pick up per share per year. And that's provided every year, and it could be less invasive than the mark-to-market election, because you may only be picking up a penny or two per share versus you could pick up a couple of dollars per share if the market appreciates really well. So it's something to think about when you're looking at your securities. Is the security you intend to get in a PFIC? Does it have the QEF election available to it, or will you be doing the mark-to-market? Determination of PFICs is a difficult and time-consuming process. UMB uses the E&Y's PFIC identification service. We don't recommend any fund try to tackle identifying PFICs on their own. It's a hard process. There's a lot of information that goes into determining if they're PFICs that is not readily available for you to make the determination if it's a PFIC or not. E&Y spends several months analyzing a security to determine if it's a PFIC or not. So you can't really just do a quick analysis and say it's a PFIC. One, foreign financials aren't formatted same as U.S. Financials, so it's hard to determine if they meet the qualifications of a PFIC without having all the knowledge of how to determine that. Mark-to-market can cause recognition of unrealized gain on a security to be distributed as ordinary income. So I had mentioned before about the span of income, but it also has another problem doing the mark-to-market election. All the income you recognize on a PFIC is ordinary income. So when you ultimately sell a security, you might have recognized a capital gain of $3 per share, but it really was distributed to your shareholders over the time that you held it as ordinary income. So you get no benefit of capital gains. You basically distribute all that as ordinary income, as if it was dividends received by the fund from that company. So there are some disadvantages to PFICs because you realize pretty much no capital gains when you're invested in PFICs. These adjustments are temporary and will reverse, but the character of income recognition is permanent. One of the things, if you have a mark-to-market this year, you buy security A at $10 a share. At the end of year one, it goes up to $12. You recognize that $2 and distribute that to your shareholder. At the end of year two, the price goes down to $11 a share. You could reverse that $1 of mark-to-market, you distribute it. But you can never reverse lower than the original cost of the security. So these are just some of the things to be cognizant of when you invest in securities that are PFICs. When you purchase them, you may not necessarily know if they're a PFIC or not. You may want to, if you want to get into a security that you're unsure of, run it by UMB and ask them if it's in their, if it's in E&Y's PFIC list. They may be able to tell you, they may not. It depends if it's come up on somebody else's, or the security may have to be run by E&Y to determine if a PFIC determination is made. Most PFICs, E&Y has probably made the determination on pretty much 95% of the foreign entities that are out there. Next slide, please. Okay, the next adjustment we have is real estate investment trust, better known as REITs. REITs are income-producing securities with a 12/31 year end. They all have a 12/31 year end. And the character of their distributions is determined after the year end. They're doing this character reclass in January and February, after you may have already made your distributions for the year. The reclass information is posted on the nareit.com website or the WSC.com website. This information becomes available mid-January, and you'll basically use this to go reclass all the income you received as a dividend. Some of it may be reclassified to long-term capital gains. Some of it may be reclassified as return of capital, and that affects your unrealized amount because your unrealized goes up and your ordinary income distributions go down. All these PFIC adjustments have one common characteristic. They all reduce ordinary income. They can increase your capital gains immediately with a long-term gain adjustment, or they can increase them at some point in time when you sell the lot, when you recognize that return of capital, which has just increased your unrealized. So they're just things to be aware of. Reclasses of income normally are treated as long-term capital gain and return of capital, known as ROC. ROC increases the tax unrealized amount, as I mentioned, and most REIT adjustments are booked above the line as part of the financial statements. True-up adjustments are booked when the financial information is available. So when we're doing your tax provisions to do the financials, REITs, most of the adjustments when the information is available, even with an estimate, are booked what we call above the line and included as part of your book information to more properly reflect your financials to what they should be. It's one of the few adjustments that is taken in above the line so that they would basically be reflected in your book numbers and not as a tax adjustment. The true-up, or any information that's available after we publish our financials, would be the information to get it into what the final numbers in. We may have used, for example, for a fund at 50 cents per share was treated as long-term capital gains and find out that it was only 49 cents. We would reclass and true that up to get them into the right position. Funds that invest heavily in REITs typically should have a 12/31 year end. Any year end other than 12/31 could create a lot of headaches in doing your financials and tax work because you're trying to gain information that you don't have during the middle of the year, and you'd be basically having no information to basically provide accuracy with your estimates and distributions. Next slide, please. ETF and mutual funds investments. Similar to REITs, ETFs and mutual funds investments have tax adjustments that must be accounted for. At the time you receive them, you may not know. They may be distributed as ordinary income, and at a later point after the fund's year end, they will reclass and say that distribution is a long-term capital gain, short-term capital gain, or a return of capital known as ROC. Funds that own shares of mutual funds or ETFs that are held for less than 6 months and are sold at a loss, if you receive a long-term capital gain distribution from the fund or the ETF, you must reclass the loss to long-term to offset the amount of the distribution received. Basically, you can't take a capital loss as short-term and take a capital gain on the distribution you received as long-term and get a benefit that you shouldn't be entitled to. So the rules make us reclass these so that you get no undue benefit out of that. Next slide, please. Okay, investments in partnerships. Now, investments in partnerships have many unforeseen tax complications that advisors should be aware of. Distributions from partnerships are typically treated as a return of capital for tax purposes. And for book purposes, in many cases, they are treated as return of capital. If for book purposes, they know that a partnership will produce income, to fairly represent the books, that distribution is not treated as a return of capital, but treated as income to make a fair representation. So, but for tax purposes, we will always treat it as return of capital. And income, expenses, gains, losses, and all other income items are picked up from the K-1 issued by the partnership. The income from a K-1 is always recognized on 12/31 of the year, no matter when the K-1 is received, which I mentioned earlier when we were talking about determining your distributions, for example, at Excise. You're doing distributions at Excise time when you're not going to receive the information on the partnership that you're invested in until 3 to 5 months later. So you'll have to do estimates to kind of get the numbers in line with what you need to properly distribute without being over-distributed and having a return of capital for the fund, or being under-distributed and incurring an excise tax. So these are adjustments that basically have a lot of impact. Also, there's another adjustment on these that need to be aware of, is a 751 reclass, which you may look and say, well, I should have all capital gains from this investment when I sold it, and you may not, because the 751 reclass that the partnership determines could reclass a good portion of that to ordinary income. And you don't know that at the time when you're looking at that. So it's something to be aware of. Next slide, please. Continuing on this, I had started to already mention the 751 reclass. Since K-1 information is not available until K-1 is received, estimates have to be included in order to minimize the possibility of incurring excise tax. So UMB, when they're preparing your excise estimates, and at the time, which is the most critical, they'll use estimates based on last year's holdings to determine what we should be including to determine if we have to distribute, what amount we have to distribute, so we don't over or under or over distribute. If we don't have proper numbers and you get this information a lot later, you could possibly have incorrect 1099s, which is something a fund never wants to have. So the accuracy of the information we have is very important to the fund, because you don't want to mess with your shareholders and tell them they have to redo their tax returns because we have to send them a revised 1099. So it is always important that we get this information as correct as possible. Some states are looking into requiring funds to file tax returns if a partnership conducts business in their state. This is going to be an issue that's growing as states are looking to make more income. More states are looking that mutual funds that invest in partnerships should be filing tax returns in their state and paying state taxes in their state, either a minimum tax or a franchise tax or tax on the income that you have. So right now, we're filing in a minimum number of states possible for mutual funds. And we're trying not to file unless a state really comes after you, and we try to make an argument to keep out of these states. But as I said, as states are looking more and more to increasing their lines of revenue, mutual funds are a great target for them to get more money. And investments in partnerships is one way they can claim that you have nexus in their state. So, you know, and you could end up having to accrue tax liabilities on your financials for state taxes that you shouldn't really have to incur. But this is a part of the new way that things are going. So you could end up, instead of doing one state, you could end up having 10 or 12 state tax returns based on the investments that you hold and how states push to get this stuff implemented for them to basically get a bite of your apple. Funds with significant investments in partnerships should elect an 11/30 year end. Any of our MLP funds or any fund that elects to have a lot of partnerships in there, and you are limited to 25% MLPs in your fund. You can't go over that unless you want to be a C Corp, like we have a MLP C Corp in our fund family right now. 11/30 is the ideal year end. Since a fund is considered to receive the K1 on 12/31 of the year, if you have an 11/30 year end, you pretty much have 11 months to do the tax work to determine what your gains and losses are and have your financials accurate and your excise accurate, because you're not considered to receive the K1s until 12/31 of that year. Funds that have significant investments in partnerships, multiple distributions during the year do not really work well because the character of the distribution is not known at the time. Because mutual funds are limited to the number of capital gains tax distributions they can have, technically we have 3 distributions max that we can make. We can make an excise distribution, a fiscal distribution, and what's known as a cleanup distribution, which is very seldomly used because it's a small distribution. It's limited to 10% of the capital gains distribution. So it's only used in emergencies, but you're limited to 2 distributions. If you're making multiple distributions, you could be required to do a reclass from capital gains to ordinary if you're distributing multiple times throughout the year and you distribute capital gains, or from ordinary to capital gains, depending on what these are. So you want to minimize the amount of distributions that you're making when you have significant investments in MLPs or partnerships. Next slide, please. How many of you are started to put to sleep yet? Tax is not the most influential thing to keep you awake at this time of the day. Next slide, we only have 2 more slides to go. Futures, forwards, and options contracts. Depending on the type of contract you enter into, a futures, forward, or option contract could be subject to 1256 treatment. Now, 1256 treatment is any realized gain or loss is treated as 60% long-term and 40% short-term, no matter how long you hold the contract for. It's very beneficial to a fund for 1256 because you get long-term capital gains treatment even though you didn't hold it long enough to get that. But the disadvantage is unrealized appreciation or depreciation is marked to market at both fiscal and excise. So there's that fan of income you're picking up, and it's marked to market and treated 60% long-term, 40% short-term. To qualify for 1256 treatment, the contract must be traded on a qualified board or exchange. It must be broad-based, having 8 or more indices in the index. It must be a regulated futures contract, a non-equity option, a foreign currency contract, or a dealer equity option. Examples of 1256 contracts would be a futures contract on the NASDAQ, the S&P 500, the Russell 2000, or an option on some ETFs. There actually is a list out there which tells you the options on certain ETFs are qualified for 1256 treatment. And if you can go to the 21st Securities website, they actually have a list of those ETFs that are qualified for 1256 treatments if you have options on them. Now, the mark-to-market is reversed on the first day of the next tax year. So the mark-to-market is not permanent, but it does create phantom income in the period that you are in that tax year. You're basically distributing income that you don't necessarily have. But it also works the opposite. If it's depreciation, you're lowering your income because you're recognizing the depreciation on that contract too. So it has its advantages and disadvantages. Next slide, please. Foreign currency contracts. All foreign currency contracts are subject to 988 treatment. Realized gain or loss of foreign currency is treated as ordinary income for tax purposes. Currency gain and loss is treated as capital for book purposes and ordinary for tax purposes. So on the financial statement, you'll see the foreign currency in the capital section of your financials. And on the tax return, you'll see it in the ordinary income section. So there's a discrepancy or difference in treatment between what GAAP says, how GAAP says it should be treated, and how the IRS says it should be treated. So it's something you should be aware of, because it can, if you're looking at your trial balance, have an impact on what you're distributing. Currency contracts can be treated as capital if you make the 988B1 election, and that must be made at the time the trade is entered into. The trade must be annotated with a section 988B1 elected for this transaction stamped on the face of the ticket. You must maintain a separate file and keep these trade tickets separately for this election. Most funds don't do this. It's not a very useful election, but it is available. Funds that are trying to increase capital gains, this may be something to do, but it is a time-consuming process that you must be aware of. FX losses can reduce ordinary income. Distributions take into ordinary income distributions. You must take this into account when you're preparing your estimates. So that's the end of our presentation. I've covered pretty much all the tax adjustments that are commonplace. This is not going to make you an expert. It's just to give you an idea. If you have any questions on any of these, you can always feel free to call us and ask us a question. We'll be glad to answer a question and walk you through if there's something that you've invested in your fund. All right, Amy, I'll pass it back to you.
Great. Thank you, Leonard.
Okay.
So now we're going to hear from Bruce Little at UMB, who will be discussing the tax process between the service providers and the advisors. Bruce?
Thank you, Amy. So let's discuss tax processes for a couple minutes. UMB Fund Services Tax Group prepares calculations that indicate the amount of net income or loss earned by the fund and the amount of net short-term capital gains or losses and net long-term capital gains or losses realized by the fund. These calculations start with the book numbers and then add in the tax adjustments. So if I can get you to remember two things from my part of the presentation, and I've just got a couple slides here and won't take too much longer, but if I can get you to remember two things, the first thing that I'd like you to remember or know is the fiscal year end of your fund or your funds. And to know that that fiscal year end locks in the fiscal year net income and locks in the realized net short-term and realized net long-term capital gains and losses. So if you look at this fiscal year slide, prior to fiscal year end, UMB Fund Services is preparing interim calculations. And you can reach out to your MFAC contact, and they can reach out to us and ask us for an interim calculation. That includes fiscal year to date, actual book, realized short-term capital gains and losses and long-term capital gains and losses. And it can also include those tax adjustments that Leonard spoke about. We can prepare, if you want something very quickly, we can let you know what your book numbers are. If you want us to include it in the tax adjustments, it takes a little bit longer to process those calculations and include that information in. At fiscal year end, we'll prepare income tax provision, and we'll calculate the book to tax income and then the realized short-term and long-term capital gains and losses. And this includes all the fiscal year actual book net income, realized gains and losses, and it includes all the book to tax adjustments. We prepare the notes to the financial statements for the tax section, and we provide that to the auditors for their review for the audit. Next slide, please. The second thing that I want you to remember is that October 31st is the excise tax capital gain measurement date, and that locks in the excise tax period, realized net short-term and realized net long-term capital gains and losses. Now, however, net income is measured on a calendar year from January 1st to December 31st for excise tax purposes. But if you can remember that October 31st is the capital gain measurement period, that also includes, that October 31st includes some of those tax adjustments as well. So prior to October 31st, we can prepare, and we are preparing interim calculations of net realized short-term and long-term capital gains and losses, and we can also put in those books to tax adjustments. When we get to October 31st, those numbers are already locked in, and we are preparing the information that then is used to calculate the excise tax requirement for October 31st capital gains and losses. Next slide, please. So our timelines prior to fiscal year end for the fiscal year, 1 month earlier, at 6 months in, at 11 months in, or prior to fiscal year end, or upon request, we're happy to prepare those calculations for you. Reach out to your MFAC associate and then ask us to prepare those calculations. For excise tax, the same thing, prior to October 31st. So September and October are good times for us to prepare those interim calculations to give you an idea of what those short-term and long-term gains and losses are, so that the advisor, the portfolio manager can make adjustments prior to 1031, prior to having to make that required distribution at October 31st. So that's my piece in a nutshell, and I'll turn it back to Amy.
Thank you, Bruce. So now we have some time to take a few questions. And this first one is for Leonard. How long can capital loss be carried forward, and how long can net operating losses be carried forward?
Well, so, under Rick Mod, capital loss carry forwards can be carried forward indefinitely if they're post 2010. Any capital losses that occurred before 2010 have an 8-year limit, and the last of those will be expiring in 2018. So basically, there's only 1 more year of expiring capital losses that could possibly be left. Most of the IMST funds, this won't be a problem for, because most of them all started after 2010. So there shouldn't be any issues with that, with capital loss carry forwards. They're unexpiring, but there is a catch for these capital losses. They do have a short-term and long-term character, where the old capital losses were all short-term. The new ones, post-BRIC mod capital losses, have a character of short-term and long-term. And another thing to be aware of, if a fund does have pre-RIC mod capital losses and post-RIC mod capital losses, the new capital losses, the new capital losses must be utilized before the old pre-RIC mod capital losses can be utilized. This was part of the budget agreement from Congress, that to give us capital losses that don't expire, we would give back some of the losses that do expire, so that it was considered to be revenue neutral. Now, that basically goes with the capital loss carryforwards. On NOLs basically expire in the current year. They basically get written off the paid-in capital. Unlike a corporation, which can carry back its NOL and carry forward its NOL, RICs, once you distribute, you can't take the money back and say, oh, I have an NOL this year, I want to take the money back from last year. So we don't get to carry back NOLs, but we do have something now that's called a late year loss deferral. It allows us to defer losses that happen after the end of the fiscal year that impact the excise year, or after the end of the excise year that impact the fiscal year, because of distributions you made. So, for example, a fund that's a 6/30 year end, at 12/31, the fund had $600,000 worth of income from 7/1 to 12/31. So you made that distribution for excise. That money went out to the shareholders. They received the 1099. When you get to 6/30 18th, you find out that now you only have $200,000 worth of income. So you distributed $600,000 on this fiscal year, but you only have $200,000 worth of income. The new rules allow us to defer that loss of $400,000 to get us back to the $600,000 that we had, so that we don't have a return of capital, and the character of the distribution for financial purposes matches what we have in income, and we could take that loss on the first day of the next tax year. And the same thing works for excise. If we distribute for fiscal and excise makes us take a loss, we can defer that loss. And the team at UMB knows how to calculate these, and when they're doing your fiscal and excise returns, they do these calculations and defer the losses to the next year where possible. These are automatically done, and pretty much you don't have to worry about those. Amy?
Thank you, Leonard. So this next one, Bruce, I think you'll be able to answer this. As it relates to the distribution process, what is the estimated lead time for the tax team to prepare capital gain estimates for fiscal and excise?
That's a good question, Amy. So I'd like to say it depends. It depends on if the client wants, how complicated the fund is, and how many of those tax adjustments the fund has. If the fund has very few tax adjustments, it's easy for us to do the calculation. If the fund has a lot of the tax adjustments, it's going to take longer for us to do those calculations. So as far as the estimated lead time for letting us know whether you want us to prepare a capital gain estimate or not, if you can let us know a week ahead of time that you're interested in that, then we'll put it on our schedule for the calculation a week later. Now, what we would like to do with the year-end distributions is the MFAC folks will be reaching out to the clients and discussing the year-end distribution dates with them. And as part of that, if there is a client that wants a calculation prior to October 31st, that's a good time for them to discuss the timing of that calculation, that capital gain calculation and estimate, and then we can put that on our calendar, and we'll know in advance and can prepare that ahead of time.
Okay, thank you, Bruce. So the next question we have, and I think, Bruce, I think it goes to you again. Can the advisor get a copy of the wash sales report?
Yes. Yes, we can provide the advisor with a copy of the wash sale report. It will show the tax lots that have been assigned. It essentially shows what sales have been, from what sales the wash sales have been deferred, and then it shows what purchases those wash sales have been tacked onto. So just reach out to your MFAC associate and or to your contact in the tax group, and we'll be glad to provide that to you.
Okay, great. Thank you, Bruce. So we are coming to the end of our webinar here. There are some more questions, but in order to keep to our time, we'll go ahead and end it here. A summary of these questions and answers, and any answers that we didn't get to, will be sent out at the end of the week, as well as a recording of this webinar to all of the advisors. So you'll have that for yourself. So Marty, I'll go ahead and pass it off to you to finish us out.
Thank you, Amy. Those are some interesting questions. Thank you for joining us today. We know that each of you are very busy and that this can be a complicated process. So we appreciate your interest in learning more about this topic. I would also like to thank our two panelists today, Leonard DePietro from Tate Weller and Bruce Little from UMB Fund Services. If you have any additional questions, please contact any of the panelists or me. Also, you will be asked to complete a short survey on today's webinar to help us on conducting future webinars. Thank you again for your time today, and we look forward to you being with us on our next webinar.